Okay, I apologize. I don't think it was a disaster, but it wasn't amazing either. This will just be my hot take on Alibaba's recent earnings. Do take note though, this stock is currently my largest position, so just take this video for what it's worth. I'll just be sharing some of my interpretations of the numbers and maybe the upcoming strategy that I think the management is looking at and whether I'm buying more Alibaba stock or not. So just to echo some of the headline numbers, Q3 revenue is up 10%, failing to meet analyst expectations of 11%. Earnings, however, despite beating estimates, was down 23% year-on-year. Revenue, 10%. What happened to Alibaba being the fang of China and having that bad status? And what happened to the monstrous growth it used to capture as China modernized and grow? So to add fuel to the fire, earnings were largely impacted. And if you were to use the trailing 12 months EPS to calculate Alibaba's PE now, it's sitting at a whopping 25 to 28 range, despite trading at slightly above $100. So is it really that cheap after all, or are we stuck back holding? So let me attempt to dissect this. And you know what else we can dissect? The like button, of course. So please don't be too kind to it. So for a start, unlike decreasing users from another company, where I wouldn't be mentioning names, Alibaba managed to add 15% more AAC in China, which is annual active consumer, and 37% more AAC on the international front. So Daniel Zhang, which is the CEO of Alibaba, also pledged that they are en route to reaching 1 billion AAC for China alone at the end of this fiscal year. So the end of Alibaba's fiscal year is on March of 2022. So I personally believe that the data through January and mid-Feb was already fleshed out to the different management team for Daniel to be this confident. So let's take a moment to conceptualize this. 1.28 billion annual active consumers globally. But yes, I believe the growth of consumers, especially in China, will start plateauing because there is only that fixed number of people that can be active on your platform on a monthly basis. But for people that uses Alibaba's platform on a frequent basis, just take some time to appreciate how integral this platform is in the consumer's life. At least on this front, it seems like there are much more room to grow in their local consumer services and international vertical. So I think at least on the strategic level, it does seem like there are lesser and lesser room for Alibaba's core business to continue growing at a clip of 20 or even 30% where investors are used to in the last 5 years. And some people are saying that, hey, they are currently on the maturing side of the growth curve. I think this is something most of us can agree on, both bulls and bears of Alibaba. That said though, there are different stages of maturity as well. And I believe that we all have our own opinions on where Alibaba is currently at. So another key element is whether you believe that the management team can execute precisely and accurately and to find the next curve for Alibaba to grow into. So in terms of execution at least, Alibaba managed to dominate the 3 out of the 4 different industries that they are currently operating in: e-commerce, finance, logistics, and cloud. Sure, there are also history of them losing out to the different competitors due to the competitive landscape, like their attempt to compete with WeChat in the earlier days of social media, and also the famous Lazada acquisition in the Southeast Asia region that lost to Shopee until today. So I'll let you decide on how much of an execution discount you wish to ascribe to the business. But let's not forget 3 out of the 4 industries they are currently dominating in. So now let's look at the 5 key pillars in Alibaba: China commerce, international commerce, local consumer services, Cainiao, and AliCloud. So the digital media and innovation initiatives are just essentially side projects, and it can be done away. So I won't be wasting my time there. So firstly, let's speak about China commerce. China commerce is clearly showing multiple signs of maturity by growing revenue at only 7%, while their core money-making machine actually decreased by 1% year-on-year. So management has been citing slow market conditions and competition as the 2 main culprits. So my personal view though, slowing macro conditions are real. I think especially for people that follow China's development closely, the trickier part now is which factor is weighing down onto Alibaba more. Is the management team trying to mask their incompetencies or fending off competitors with the name of macro conditions? Hence, as shareholders, we must corroborate this story with their competitors. So JD is reporting their earnings soon, and I will definitely be sharing my opinion on this matter soon. So to me, the impact on CMR is essentially transitory, and it's a necessary step to essentially not give the competitors an easy time. So this fight alone is not going to be sustainable in the long run. So I believe that investors will soon come to realize this. The adjusted EBITDA was down 20% year-on-year due to a decreasing margin and a compressing on the main business, and also more aggressive expansions on platforms like Taobao Deals and Taocaicai. So you can also observe that the EBITDA margin plummeted from 45% to 34% year-on-year, and that is something that investors should be concerned with. And I don't expect this to quote-unquote correct anytime soon. So rather, I would expect it to continue fluctuating wildly between 25 to 35%. So in essence, this push towards the lower tier cities, although the growth on paper or on the surface level looks good in terms of users, but they are considered low value growth, which is reflected in the compression of margins. So for this segment specifically, earnings are bound to take a hit in the short term due to aggressive expansion. So to share something I've came across in this call, it seems like Daniel has a vision of revamping the entire commerce experience, very much like Meta platforms, or Facebook if you still can't get over the name change. So unlike Facebook, who's pouring tens of billions of capex every year in the upcoming 5 to 10 years to literally turn dreams and imaginations into reality, Alibaba on the other hand is probably pouring money into something much more achievable and much more thinkable. So just to give you an example, we know that Alibaba like to engage in high margin, low capex and low maintenance business. It's in their DNA. They are asset light, they try to exploit the network effect, and they try to build products and services around it. Recently though, they chose to acquire Sanat, which is your traditional brick and mortar, asset heavy gateway. So people were confused at first, but it seems like they are slowly executing on their vision to redefining experiences. So particularly for grocery shopping, consumers love to see and touch the things before making the purchase, checking whether the fruits are spoiled or if the vegetables are fresh. So the tedious thing is, every time after your own grocery run, you or your family will be lugging bags and bags of groceries to your car first before visiting the mall again. Worse still, not everyone is blessed enough to be able to afford a car. And if you don't, you might have to leave grocery shopping till the last of your mall visiting agenda, or be forced to huddle your grocery bags throughout your entire mall visiting experience. So in this example, if Alibaba is successful in redefining how we shop, the ideal scenario that they are currently painting would be that upon making payment for your groceries, you don't have to pick up anything at all, and you continue with your other errands, running to a bank, catching a movie, and upon reaching home, your purchases are at your doorstep. It saves you time, it saves you effort, and it reduces the headache of running errands. And that is what I call increasing value proposition. So this don't only apply to groceries, and on commodities which are more tailored in nature, like clothing and shoes, that requires more trial and error, if I may put it. So I believe many people have bad experiences of refunding because some of it might have a tedious process, and many people will resort to going down to try but choose to purchase it online instead due to the cheaper pricing. So touch your heart and you know it yourself. So the interesting thing is, if Alibaba manages to sort out the kinks and the issues with the entire chain, the physical stores can very well be platforms for consumers to pick out and try on the items, and before they know it, everything is delivered to their doorstep. So side note, by embracing the utility of physical stores only being try-ons can reduce the manpower needed and reduces the need for physical stores to stockpile because it will run from a central warehouse governed by Alibaba. By doing so, they hope to expand their value proposition to cater to a diverse customer base and make this entire experience more tailored, and in turn, make Alibaba's product offering stickier than ever. However, in order for this to happen, Alibaba will have to solve key issues such as logistics, supply chain, and the coordination amongst different networks to provide a seamless customer experience, which would also involve huge amount of data crunching and computing power, of course. All in all, I think Alibaba is exactly the kind of company that is able to leverage on their existing offering and existing platforms to push this frontier a little bit further. Oops, I think I got carried away with the future plans of China's core commerce segment and Alibaba's plan of a hybrid commerce experience. I think Alibaba should start hiring me to be the salesperson. Anyway, in the next video about the earnings, I'll break down the remaining 4 pillars and provide some thoughts behind the numbers. I'll see you in the next video, but more importantly, I'll see you on the moon. Goodbye!